Hello, friends. Good morning, good afternoon, and good evening, whenever and wherever you're watching this lesson from. So, this is a continuation of the lesson we started looking at, that is insurance. And the last time we met, we looked at principles of insurance. So today we're going to look at steps to be taken when effecting an insurance cover, when you're taking out an insurance cover. The first one is that an approach, you need to approach an insurance broker or company, okay? You approach an insurance broker or company. You can involve a middleman or you can just go direct to the insurance company. When you go there, the second step is that you obtain a proposal form. You fill in details in utmost good faith. Utmost of good faith, it means that you say everything, you don't leave any out, you don't leave out any fact that may lead to the what, to the risk occurring. To happen. Okay. Otherwise, the contract will be void if you leave out some facts. Now, insurance broker or company will assess the risk to calculate the correct premium and decide whether to take the risk or not. Then if they accept, you, the proposer, pays premium. What is premium? Premium, like I already explained, that this is the money you pay to the insurance company. Okay? Then the cover note may be used to make a claim before a policy is issued. Okay? A policy is issued after a period of time. It contains all terms and conditions of a contract. Okay? Of a contract. Okay, now, what is contained in the proposal form? A proposal form, like I explained, that this is just an application for insurance. It gives the details of the risk to be insured against. Not only this, but also it gives the details of the applicant, the name, your name, a nationality, NRC, and any other credentials. Okay, so the proposer complete details in the proposal form in utmost of good faith, like I said, giving full and accurate details about the property and the risk being insured against. The company will use or the broker will use to assess the risk, decide whether to accept or not, and also calculate the premium. Okay. Now, what do you do? Let's look at procedure in making claims. When a risk occurred, for instance, for example, if you insure your property against fire and it later got damaged by fire, then what is the procedure in making a claim for you to be compensated? Okay, you need to inform the police of the calamity accident immediately it happens. You need to notify the insurance company of the calamity or accident as soon as possible. Do not delay. Okay? Or else you'll be playing with what? You'll be playing with evidence. Okay? You may not be compensated if you take too long. Immediately inform the insurance company and inform the police. Okay? So you need to inform the insurance company if the item was insured with other company. Okay? Also insured with other company. If more than one insurance company is are involved. Complete a claim form giving full details of loss suffered. Okay? The insurance company the insurance company assessors will inspect the damage and determine the amount to be compensated. Okay, the amount to be compensated, that is just an error. Okay, a mistake, I mean. The client signs an agreement of loss form to bind him to accept the amount of compensation arrived at. Insurance company settles the client by paying him or her or replacing the item lost. Okay, so now we should also know that the remaining of the item is subrogated to the insurance company. What it means to be subrogated, it means that the item that remains, it becomes the property of the insurance company. Now, who is an insurance broker? Who is an insurance broker? An insurance broker, these are middlemen between the insuring company and the insurer. They assist the insuring person to obtain insurance by, number one, by linking the company or person with the insurance company. Two, by advising the client and seeking the best possible policy. Number three, by giving information to client on kind of insurance policy offered by different insurance companies. Four, by approaching and getting quotation from insurance companies on behalf of the client. For example, the proposal form. Then five, by collecting and forwarding premium, making claim on behalf of client. Now, okay, they are remunerated by the commission called what? Brokerage. So these are insurance brokers. Okay, what is the difference between insurance and assurance? What is the difference between insurance and assurance? The term insurance refers to certainties. Assurance, certainties, risk that must happen, such as death. And the term insurance refers to probability. The risk may or may not happen, such as fire, theft, accident, etc. Okay? Now, when it comes to life assurance, we have what is known as the whole life policy. The whole life policy, it is a policy which provides compensation of money or sum insured only upon death of the insured person. The insured person does not receive compensation money before his or her death. The money is given to him or her, to his or her beneficiaries, who may be his or her wife, husband, children, or other dependents. Premium is paid for whole of his life. The money will be used to, number one, pay for funeral expenses of the insured person. Two, pay the outstanding debts, if any, left by the insured person. Three, other money will be used for upkeep of the beneficiaries. Upkeep of the beneficiaries. Okay? This is the whole life policy. Now, we also have this policy which is called the endowment policy. Endowment policy, it is a policy taken for a specific period of time, for let's say 20 to 60 years. It provides compensation money. For example, that is the insured money either at maturity date or at death of the insured person, whichever comes first, compensation is given. Now, this is very important. It is essential. Because it provides insurance where an insured person dies before maturity. It is also saving money where the assured survived up to maturity. Okay? If you don't die, if the person does not die within that period, the person will be given the money, will be compensated. Okay? So, number one, this is expensive. Okay? It can be with profit or without profit, but that is interest. Now, this is expensive. Why? Because number one, it allows someone to be saving money, okay? Also, to be to be covered for life assurance. So if you don't die, you'll be given money. If you die, expenses will be catered for. During the funeral, expenses will be catered for, okay? And also paying outstanding debt. All right. So that is the endowment policy. Okay.